All right, are we ready to get going? So we can, I can whip through a few things in chapter 2. There's just, I kind of glanced through it before I came to class, and a few things that I want to go over just briefly, and then give you guys some time. I'll probably go over how to do the assignments again just briefly, and then hopefully give you guys some time so I can come around and make sure we're all on the same page. You guys are getting started correctly anyhow on those and kind of have a basic understanding of how things are going. So let's do that. First, I found this kind of interesting. I'm always looking for articles like this, and so I see a headline and it catches my interest, and I go, well, I'll do that and bring it to class. So the headline basically says, can you save $1 million, by the time you retire, say, if you're never make over $50,000 a year? And how hard do you think that would be? Anybody got any idea? Okay, now I know this isn't a personal finance class, but some of these concepts work both ways, both for personal and for your business and whatnot. And so these are some of the things that we're going to learn. Okay, well, how do you do that? How do you figure that? Well, you bring up Excel, get a blank workbook going there, make it nice and big so you guys can see it. I'll just whip through it really quickly here, but we're going to go over this when we get to chapter 7, 8, 9, somewhere's in there, and you guys are going to know how to do this. You'll do it in your sleep, okay, by the time class is over, like I do sometimes now. I say that and then watch, I'll screw it up here, so, right? So what's my ultimate goal?
Make $1 million.
I want to make $1 million. I want to save $1 million, yep. I'm glad you made a distinction there, because making and having are two completely different things, right? Okay, so there's $1 million, and I labeled that FV, which is for future value. Okay, that's where I want to get to, right? The $50,000 doesn't really have a lot to do with this, okay, because we just want to figure out what we're going to save. Okay, what we need to save, say on an annual, or we can make it a monthly basis, either one. I'll switch it, do both. But we need an interest rate. The article, when I looked at it, they used a 6% earnings rate. Now, Luke, can I get 6% at the bank? No. Okay, but can I get 6% on some other investments? Yeah. Okay, the long term, and by long term I mean like 100-year average for the S&P 500 is closer to 9%. Okay. So 6% is kind of conservative, okay, if you compare it to that. And if you were investing for the long term, at your guys' age, it's like go big or go home, okay? Let me tell you, you get to be my age, and most people say I should be conservative. I say BS, okay? I'm still young, still all in, basically, okay? Not conservative at all. I kind of violate some of the principles, and you listen to financial managers and those folks, okay? You guys should be aggressive, not stupid, okay? Not stupid. There is stupid, and that would be buying an individual stock and putting all your money into it. Boy, unless you really knew what that stock was. Maybe you worked for them or something. But yeah, diversify, buy a small cap index fund, low cost. I mean, that's kind of aggressive, but it's very diversified. Over time, that's going to perform extremely well. Anyhow, I got to get back to this. So let's use that. They're 6%. I got to enter that as 0.06, right? Okay, as a decimal, it's 0.06. So we've got to kind of get used to that, entering these things. Okay, and if I want to, I can make that look like a percent. And how many years? Well, you guys are 20, 21, 22, right? Let's say you don't get going good till you're 25. And you want to retire when you're 65. 40 years, fair enough? Okay, so I plug in 40 years. What's that going to take me then? Okay, what do I got to do? I come up here and I click on this little FX. There's other ways to get to this too, but this is what I'm familiar with. It gives me all kinds of these, and there's about 100 of these different formulas. We'll probably end up using a dozen of them. Okay, so you'll get used to those dozen, and you'll kind of have them in the back of your head. In this case, I'm looking for what kind of payment is it going to take, okay, for me to reach that $1 million milestone at 40 years and 6%. Okay, so I click payment and I click OK, and that's what I'm solving for. Now it wants to know what my rate is. Well, I got that right. NPER is the number of periods. Okay, There's a distinction between that and years, and I'll get back and we'll take a look. We'll redo this a little differently. So 40 years, right? I don't have a present value, okay, but I've got a future value that I want to get to, right? Okay. The present value might be in this particular equation. Let's say Grandma gave you $5,000 when you graduated from college, and you wanted to stick that in there and start with that. You could plug that in too, okay? But I don't have that. Instead, I want to reach $1 million, okay? It comes up negative, and that's because the way I like to describe this is that's what's got to leave my pocket, right? That's what has to leave my pocket in order to make that happen. About $6,500 per year. This is on a per year basis, so that's a little bit. Okay, what's that? $500 a month, a little better than $500 a month. Okay, I want to be more precise. Maybe I want to know exactly what it is per month. I can do it this way. Okay, there's a few different ways you could do this, but I could take my rate and right in here I could divide it by 12. So now I get a monthly interest rate. But my number of periods then need to be monthly, and so I need to multiply it by 12, so I get 480, right? I'll just take it times 12. It actually gives me my answer here before I click the button, and so I can look at that and say realistically, is that correct or not? Yeah, okay. Sounds like a lot of money, right? Okay. Most of you are probably going to go to work for someplace that has a 401k plan or something similar to that that's going to be kind of a match, okay? And if that's the case, you may have to put in $250 or $300 a month here, and your employer might match the rest of it, right? Okay, and get you that $1 million. Now, that's also if we're doing it at 6%. What did I tell you the long-term S&P average is? 9. Okay, so remember that 502. I'm going to put in 9% here, and let's see what happens. Huge difference, isn't it? Huge difference. So a small change in interest rates makes a huge difference over time. Okay, the compound interest. What is it? Was it Ben Franklin said it should be one of the great natural wonders of the world or something? It's compound interest. Okay, maybe it was Einstein. It was Einstein. So yeah, huge difference. So all of a sudden it takes it down to $213 per month. That's pretty doable, isn't it? Especially if you got a 401k plan and they're matching. Okay. One thing I would say about this too is that in order to do this, you probably want to take advantage of IRAs or Roth IRAs, because that way your money grows tax deferred if it's an IRA, tax free if it's a Roth IRA. Okay. If you were doing it outside of an IRA, you'd have to pay some taxes on this as it earned income throughout time. Okay. Now, yeah, I can get into a longer speech about that, but that'd be a whole class period. So, okay. So let's roll on. Again, chapter 2 here. I think I got to about.
I thought it was slide 10. I thought it was slide 10.
God, I thought I got past that. Okay. Price to earnings ratios. It's just a multiplier that has to do with the earnings. I know I said this, I don't typically look at this that strongly, although I look at it in this fashion. I think I said this. So if it's a high price to earnings ratio, I would expect that company, if I'm going to invest in it, they better be a fast grower. Okay. If it's a low price to earnings company, there's a pretty good chance that they're a mature company, going to level off. And we can look at some of these too, maybe. It does allow some market value comparisons, especially in companies that are in the same industry, maybe. If they're in a similar industry, you can kind of take a look at that. Firms with higher expected returns, again, growth, right? They can be confusing. That's why it's not, sometimes worth, and I showed you, I think Beyond Meat, theirs is negative right now because they're not making any money, right? Tesla's is negative right now because they're not making any money, okay? Amazon's is probably really high because Amazon doesn't show a lot of income. They do show a little bit now, but up until a few years ago, they didn't hardly show any. The income statement's one of the three major statements that we want to look at, and that you guys will look at, especially when we get to Project 2, are the income statement, the balance sheet, and the cash flow. Okay, and we just wanted to touch on these briefly here because you guys are going to spend some time with these. It's the amount made or lost during a specific period of time. Often we look at them for year-end, or a one-year period of time. Balance sheet is a snapshot of what the company looks like right now. Okay, and again, balance sheet or book value, the balance sheet shows you the book value of a company. Okay? Market value, when we're talking about publicly traded companies, is completely different. Okay? And it can be different with privately owned companies as well. In other words, even a local company, its accounting book value might be fairly low because they've got some assets that they've depreciated. Maybe they're building, right? You build a big shop, you're a diesel guy, you build a big shop, you get to depreciate that over time. If you own that for 20 years, it's just about fully depreciated, so your cost basis is zero. That's what it's showing on your books. But that building's probably still worth, $500,000 or $750,000. So that's why there can be big discrepancies between book value. One of the reasons there can be big discrepancies between book value and market value. Okay. Some balance sheet items. Okay, we talk about current assets, right? That's cash and anything that can readily be converted to cash. Okay, basically, within 1 year. We talk about that within 1 year. Okay, so marketable securities are a current asset. Accounts receivable are considered a current asset because you can turn those into cash. There are companies that buy accounts receivable. Okay, they're called factoring companies. So if you've got $100,000 in accounts receivable and you need some cash, you can go to a factoring company and sell it to them. They'd give you 90 cents on the dollar maybe. Okay. But you'd have cash. All of a sudden, you'd have $90,000 cash in your. Some of them do it just right on the front end. When you go to Haver Home and Hardware, they used to. I'm not sure if they still do, but if you were on their account thing, it used to be anyhow. You'd sign up and you'd get a bill from a different company. Okay, I mean you'd charge it, and your bill would come from XYZ company, right? They were automatically transferring those accounts receivable to this other company and letting the other company handle it. Okay, they were probably getting 95 cents on the dollar. But basically what you're doing with a credit card, right? If you're paying with a credit card, Visa's going to collect from you, not the company. Okay, so it's a very, very similar concept. Some other balance sheet items, prepaid expenses, investments can be long-term investments in equipment, real estate, those types of things, but also other investments, other companies, et cetera, plant and equipment. Total assets, the accounting equation. Anybody remember this from your accounting? What's the accounting equation?
Assets equal liability equal stockholders' equity.
There you go. That's it. And you can state that many different ways, right? You could say assets minus liabilities equals stockholders' equity, or assets minus equity equals liabilities, right? You could move it around a little bit here and there, but it's all the same thing, right? Okay. That's important. When you start going through some of these things, it's important to kind of just know that, always have that in the back of your mind, because there's some times when you're doing some equations and you just have to kind of remember that. Short-term obligations are those things that are payable within a year, right? We got current assets, we have current liabilities. Okay, what's the difference between current assets and current liabilities? What do we call that? Working capital. Thank you. Okay, what if we're expressing that as a ratio? What do we call it? It's a trick question almost. Current assets to current liabilities as a ratio. Yeah, current ratio. If we take out inventory, I think it's just inventory, then we call it the quick ratio. Okay, because that's things that can immediately be turned into cash then. Inventory takes you a little while usually to convert. Like I said, accounts receivable might take time if you went normally, but you can sell those to factoring organizations pretty easily. So, stockholders' equity, again, represents total contributions. Again, this is a book value calculation that we're doing here. Okay, and it can include preferred stock, common stock, capital paid in excess of par. If you look at stock certificates, they actually have a par value on there, and yeah, that doesn't really mean anything. Usually they sell it for above par, and that's considered part of the equity. Retained earnings are those things that get added. An example of a balance sheet. Okay, you guys are going to look at a lot of these, especially in the second half of the semester, so kind of get used to it. That's for 18 years when I was at the bank, that's all I did. I shouldn't say that's all I did, but that's a lot of what you do. Net worth is net worth / book value. What they mean, and they're not dividing it there. They're saying they're basically the same thing. Net worth and book value. Stockholders' equity minus the preferred stock component. And these things are of huge concern, right? The market value, it talks about here the market value, which is different. Okay, and when we get done, I'm going to show you a quick one. Limitations of the balance sheet, again, it's based on historical or the original cost minus your depreciation. And again, that can be somewhat different. Some of those things hold value far greater than what the depreciation might be. Some things depreciate faster, maybe, on the other hand, than what you're actually depreciating them on your deal. Some equipment can do that. You know, computers become obsolete in 2 years maybe, but you get 5 years to depreciate them, you know, just as kind of an example. They could become obsolete overnight, you know, depending on what kinds of new innovations come along. So, FASB is Financial Accounting Standards Board. I'm not going to worry about this. They used to talk about how you had to disclose. You had to make inflation adjustments on your balance sheet. Okay, it's no longer required. Some firms do it voluntarily. Not a big deal. I don't see those kinds of adjustments when I'm looking at public companies. Difference between per share values. Yeah, we'll look at again some of these. Here's some examples that were in the book. We'll look at some real life ones. So, and this has got to be old because IBM sucks now. And it says that their market price per share, 191. Their book value. We'll look at Microsoft is the one I got up here, and it's going to be just about exactly this ratio. Is it on here? Yeah, it's down here now. Okay, so it was only a ratio of 3.33. Remember that. Okay, because when I get to it, we'll see how that's changed. Statement of cash flows. That's important. You know, companies need cash. You got to have some cash to operate, right? You ultimately, too, you want some cash, maybe depending on your position, to take advantage of opportunities. You know, they always say it takes money to make money, and believe me, if you're sitting there with some cash and opportunities come along, you know, those are the folks that make money. I think about this as a personal thing again. You know, when my wife and I first got married, you know, I was lucky if I got paid on Friday if I could go buy a 6-pack of beer, you know, and have it in the fridge, right? Now, you know, IGA has pretty good sales on beer. And besides that, at Fridays from 4 to 6, it's happy hour, so you get 10% off on the sale price. So if there's a beer that I like that's on sale, which by the way there is this Friday, you know, I'm in a position now I can go down there and I can buy cases, huh?
Clean them out.
I can buy cases of it. I have actually in the past on certain ones. So they used to get one, and it was a seasonal in the winter. It was called Celebration Ale by Sierra Nevada, one of my favorites. And yeah, Tracy would get some in for me, and I'd go buy it by the caseload. So on Fridays, got the 10% discount. Usually when it was on sale too. So anyhow, but that's the same in business, right? You can take advantage if you're sitting there, if you actually are in that kind of a position, you can take advantage of those kinds of discounts. You pay your, right? You guys see terms sometimes, and we will work some problems like that, but 210 net 30, what's that mean? It means if you pay within 10 days, you take a 2% discount. Okay. Otherwise, you have to pay the full price between day 10 and day 30. Okay. So again, if you got cash in the bank, guess what? Is it worth it to get that 2% discount? Yeah, it is generally. We'll see, you know, like I said, when we work some problems of those when we get a little bit further down in the class. But yeah. So those things are really important. We talked about accrual versus cash method. And we don't get into that a lot. You guys probably should have done more of that in accounting, or in the accounting classes. We don't talk a ton about that here, although you'll see some quirky things on some statements. Sometimes, and oftentimes it has to do with the accrual methods and whatnot, with what the SEC requires. I kind of had given you one example about that was fairly complicated, but what the SEC requires versus what the IRS requires. Okay, they're kind of two different things. We had that in banking because you would set aside a loan loss reserve. You know, you know as a bank you're going to lose a certain percentage of your loans. Right, so you'd set aside this loan loss reserve because you needed to, right? And the feds, in this case the FDIC or the Federal Reserve, wanted to see that, but the IRS wouldn't let you deduct that until you actually took the loss. Okay, until you actually had to write off a loan. So kind of you had two separate books going on there in a sense, right? Okay. Cash flow analysis, doing those. There's places that, I mean, banks especially, they do a ton of that. So we divide it into three different things: cash flow from operating, cash flow from investing, and cash flow from financing. And what are those? Well, from operating, that's just the normal course of business, right? Money you bring in versus the expenses you pay out. From investing, plants, equipments, real estate, other investments that you might make. At one time, I know, and I don't know if they still do, Microsoft owned 2% of Facebook. You know, when Facebook got going and needed some money, I think Microsoft gave them $100 million for 2% of the company. I don't know if they still own that, but that would be an investment, right? On their books, it's obviously appreciated tremendously if they still do have it. Sale of, then the financing activity, sale of stocks, bonds, those types of things, issuing, I should say, bonds in that case, or preferred, or you could retire those as well, or buy them back, and companies do that. Determining cash flow, I'm not going to get into that. That would take quite a while, and we'll do some problems on that. Oops. Vesting activities, again, we're going to do some of these as we go along, so I'm going to just kind of cruise through this because I want to get down to the tax thing, because I had to make some changes on this just before class. Depreciation, does everybody understand depreciation? The government allows you to, if you buy certain property that typically loses some value over time, you're allowed to depreciate it. You write off a certain portion. You don't get to, except for, again, corporate law just changed, and now there is some 100% expensing. And I forget what the limit is. I think it's up to $1 million maybe. Okay, so for smaller companies, you can actually expense purchases of big equipment and real estate. Okay, that has changed in the law. I might have to look that up and talk about that again a little bit on Friday. But for the most part, and through time, you've depreciated that over time. Real estate, for example, buildings, the dirt itself you don't get to depreciate because dirt doesn't change, right? But buildings are going to become worth less over time. And so you take off, I think they're on a 28.5 year, some oddball thing, so 3.3% per year. So if you bought a $100,000 building, you would write off $3,300 per year, basically, it's depreciation. Those are, don't quote me on any of those numbers because, you know, like they say, 2/3 of all statistics are made up on the spot. So I'm kind of just throwing out numbers, but it's close to that. Okay, so you write that off, and it becomes tax deductible. It's a nice thing. It is tax deductible, but it's also a non-cash expense, right? I mean, you paid for it up front, so that was your cash expenditure. But then after that, it's a non-cash expense. It shows up on your income statement, but it doesn't show up in your cash flow. So when we're doing cash flows, we often, the down and dirty way to do a cash flow is to look at that and add back in depreciation and amortization, and that kind of gets you a rough idea of what the cash flow is. It's not precise because there's some other things you should look at. But kind of whipping through some of these dividends. A lot of companies pay dividends. This is incorrect down here, and I'll show you why. This is the part I had to change. We just had a big change in corporate tax rates. When you guys are looking at some of your statements when we get to Project 2, you're going to see big differences in corporate tax rates, actual rates that they pay, because tax rate dropped in 2018. At the federal level, it went from 35% down to 21%. Huge difference. You know, imagine if you're Apple and you're making, you know, $20 billion a year, and all of a sudden you're saving 14%. Okay, big deal, right? Why do I have it from 25 to 30? Because most states also charge, I think it's 42 states also charge a corporate income tax. Okay, and those vary. I was surprised when I was just looking at the list before class that Iowa actually has the highest. There's 12%. That shocked me. I would have guessed California, but I think California was up there, but Iowa is actually the highest for corporate taxes. Montana is, I believe, 6.8%. Okay, for the additional corporate tax. So 21 plus 6.8% gets you 27.8. I think there's an effective rate here though, because I think you get to deduct your state taxes from your federal taxes, and so it kind of changes the effective rate a little bit too. So this is incorrect down here because it uses that 40% rate. Okay. That's an interesting thing. You know, I've always said debt's cheaper than equity, and I'll still say debt's cheaper than equity, but that equation changed quite a bit when the corporate tax rate went down. You know, being able to deduct interest, okay, being able to deduct interest, that's right, and you're at a 40% tax rate, it actually makes debt cheaper. So debt got more expensive even though the tax rates went down. It seems it's one of those, doesn't make sense sometimes when you think about it. Intuitively, you kind of got to think that one through. I already talked about depreciation being kind of a tax shield. There are a few people that have been in jail because of that, absolutely. So, okay, let's get out of there, and I wanted to show you. I don't know if you guys can see this real well. I don't know if I can make it any bigger, but this is Microsoft, and remember, what was the ratio that they were at? Their price to book versus their market price, 3.33, right? Okay. It doesn't show you precisely here, but their market cap, they're worth over $1 trillion. So it's a bigger company now again than Apple and Amazon. I think it might be the biggest one out there. Their price is $137.63 per share. So that's the market price. Okay. The book value, if you look at this ratio here, that says price slash B or P slash B, which is price to book, 10.15. That's what IBM's was in that deal, roughly. It was just 10.12 or whatever, right? So their book per share would be roughly $13.50 or 60 cents, somewhere in that neighborhood, right? So huge difference in book value and market value, okay? But their price to earnings isn't out of whack. It's 25.84. I told you the average is about 17, so it's a little bit higher. You pay more for Microsoft, one, because it's still growing pretty decently, even though it's a huge corporation. But two, I think right now there are 2, maybe 3 companies that have AAA ratings in the whole world, AAA credit ratings, and that's Microsoft. J&J, but theirs may be in the process of going away. They're having some difficulties with some lawsuits and stuff with the opioid thing and whatnot. Exxon may be AAA as well, but I'm not 100% sure. If I click on bond issues here, it might tell me. Rating, AAA, okay. And we could look up some of those others, but we won't. So any questions about any of those things? You guys got a quiz due right into the class or 2 or whatever. So.
I should do it 11:30.
Oh, 11:30 tonight. Okay, good. So, because I do want to spend, I'm about 2:30 or so, not quite. So we got 20 minutes, a little better than that, to take a look at your assignments. So let me go over briefly, just real quick here, because then I want to come around and see how folks are doing. So again, home page, hit your content. Shut this one down, or it might get kind of goofy. And week 2, you want to look for the one that says Excel spreadsheet, because here it says Chapter 3 assignment, but that's the Dropbox. Okay, so we want to do the spreadsheet. Hit the down arrow, go to download, so it just opens that up for you. Hit enable editing up here. Okay. I much prefer you, I mean, if you want to do these on a separate kind of a spreadsheet, that's maybe okay. I really like this format, and that's why I've kind of set it up this way so that you can click here. Okay, remember now, we got 1, 2, 3, 4, 5, 6 problems. Okay, so you guys have 6 problems that you have to do. And so you click on here, right? Database Systems is considering expansion into a new product line. Assets to support the expansion will cost $420,000, right? It's estimated the database can generate $1.56 million in annual sales with 6% profit margin. What would net income and return on assets be for the year? Input your return on assets answer as a percent rounded to 2 decimal places, so 9.67% or something like that, right? Okay, and I do want you to carry probably most things in this class. If we're going to do some rounding, it should be out there about 2 decimal places to the right. Okay, I would think in most cases that's fine. Statistics, sometimes we had to go a little further than that, but finance we can usually get by if we're a couple decimal places out there. So, okay, if you go back again to that content and you come down here. I got 3.1 and 3.2. This particular problem is 3.2, but I think in this case both of these videos, okay, are going to tell you just about exactly how to do that problem. You know, the numbers are going to be a little bit different, but that's about it. Okay, and of course in here, if you're going to do it in here, you're going to need your little earbud things. You guys all have earbud things, right? Okay, but you can do it at home too on your laptop, or if you have a laptop here with you or something, or you guys can probably do it on your phones. I don't know, or at least listen to it on your phones maybe. I don't know how all that stuff works, but if you do that, boom. Like I said, you may want to have two computers going, or you could set up a split screen if you want to. There's different ways that you could take a look at doing those things, and that's fine and dandy. Once you get your answer, just do it down below here. Okay, that's best for me. Once you get your answer, again, I really, really appreciate it, and it really makes me happy if you come and highlight it. I don't care what color. Okay, that's fine. Other than like, if your answer is in black and you highlight it in black, that's not so good. Or even a dark gray probably doesn't work out too well. So use a rainbow color or something. Red or orange or blue or something like that. Any questions about that? Has anybody started on these problems yet? Not yet. Okay. Well, I'll quit, and I want to come around. Just make sure everybody's, you got things figured out. I'll check with each of you kind of individually, make sure that we're on the road here, and you understand, because these are due on Friday, right?
Friday at 3, I think.
At 3. It's at the end of class, so yeah. Yep. So get a little head start here. So Friday, you just got those last-minute questions. Okay.
Friday will be a work day. Is that correct?